Welcome to Accounting High.
Because this is the cash flow show, right? I want to just point out something here that sometimes what can happen is a business owner will take out more in distributions on a monthly basis than what the company is generating from operations.
I've seen that.
And they're like looking at their P&L and they're profitable.
Why? Why aren't we making any money?
Where did all the cash go?
Yeah.
So what can happen is we're making a profit on paper. We're not collecting from our customers on time. We're still taking distributions. And all of a sudden we've got ourselves in a situation where we're running out of cash.
Let's all just say that trust your accountant too when they're telling you these things, because they know what's going on. There's not going to be money hiding somewhere. They're not going to just find, lift up a seat in the couch cushion and find a whole bunch of money you can use. First things first, you got to control the spending. We got to dress the wounds here. We're bleeding cash.
Check out the cash flow show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the cash flow show. The cash flow show. Listen and learn. We'll show you how to pay yourself on what your business earns. With Nikole and OKR.
What's up, Nix?
Hey, Scott. How are you?
How's it going? I'm all right. If you ask me, I'm okay. How are you?
I'm good.
We've got new things in the horizon here. Today is episode 3 of the cash flow show. So let's get into that. What do we have in store for us today?
Yeah. So today we're going to be talking about how to pay yourself as an S-Corp owner. And so the goal here is not to talk about the tax advantages of an S-Corp versus other entity types, which we'll touch on briefly. It's more for the business owner who is already an S-Corp or thinking of becoming an S-Corp, and talking about, you've probably heard of reasonable compensation. So how do you pay yourself through wages? How much should you pay yourself? How much should you take out in distributions? How to take advantage of the tax savings that you can get with an S-Corp? How to save for taxes and the logistics around that. And a lot of times business owners are trying to understand, like, how much can I actually take out of the business and use, my family, we want a stable income, and it's just confusing. So hopefully we can demystify a lot of these things that are confusing for business owners. And then I will give some advice in terms of what I do with a very easy to follow process. So you can consistently pay yourself and it's all clear.
Yeah, for sure. Lots of neat little tips that we'll talk about today from fellow S-Corp owners, myself, and how I take my pay, which is a little interesting. I can talk about that, or lack thereof pay that I take these days.
Yeah, and that's important for people to know.
Where do we start? So in this episode, I'm going to just quickly, let's talk about why someone would want to make an S-Corp election. We can get into the logistics around managing it on another episode and all the taxi details there, but at least let's get a good overview of what an S-Corp means and the rise of the S-Corp.
The rise of the S-Corp. Yes, because I think S-Corps came around in maybe the 80s or 90s.
Yeah, it was fad in the 90s for sure, and it continued on to the 2000s. But as you said, you have clients that have been in business well over 40 years, right? So none of them are S-Corps.
Right. So we find a lot of our older businesses are C-Corps because S-Corp wasn't an option. And so typically someone nowadays would be a C-Corp if they're planning on getting outside capital. They have investors, just a better way to set it up. But S-Corps generally are single owners, sometimes partners, where you typically start out as a sole proprietor. And then at a certain point, your tax accountant probably comes to you and says, hey, I think you're making enough money now that we should switch you to an S-Corp. And so we can
You
go
save
into
on self-employment taxes.
self-employment taxes. Yeah. And I want to clarify here that you're not necessarily saving on income taxes when you switch to an S-Corp. You're saving on self-employment taxes, or they also can be called payroll taxes.
SE tax.
SE, yeah.
We like acronyms in the tax business.
So to put this in perspective and help people understand, I think the way I think of it is when you're an employee. So think back to when you were an employee and you received your pay stub. On your pay stub, there's payroll taxes on there. So if you make $100,000 salary, you're typically paying about 7.5% in payroll taxes, different from income taxes. Okay. This is in addition to income taxes that you're paying to your state and the IRS. And then you have payroll taxes on top of that. In addition to what you're paying, that 7.5% as the employee, your employer is matching that. And so they're paying 7.5% in payroll taxes. So in
And that's
total,
a little known fact for most employees. Most people who get paychecks, they don't realize that your employer is matching a percentage up to that. It's that 7.5%. As a self-employed individual, you're paying both parts of that, which is 15.3%. So Social Security and Medicare, your SE tax, this big tax that you see on the second page of your tax return, if you ever even look at it, as a self-employed individual, you're getting hit with all of that in one shot at the end of the year if you're not making any estimated payments or paying toward that. So it could be a significant amount of money for most self-employed individuals, especially as you're approaching 100,000. Like if you're making that much, then it's a no-brainer. Most accountants would tell you you need to be an S-Corp. You're going to save a bunch of money. And let's dig a little bit further on there. Let's pull the curtain back a little bit to see what that even means.
right. So in that example, right, you made the switch from an employee, now you're a sole proprietor. And so now you're kind of like the employer and the employee. So the IRS says, okay, we're going to have you pay 15.3% on your net income to cover both sides of that. The advantage then of moving to an S-Corp is, so when you move to an S-Corp, what's going to happen is you're going to have to pay yourself a salary. And that's going to be just like you pay your employees. You're going to get a pay stub, you're going to get a W-2. And because you are the employee, you are paying 7.5% on that. And you're also the employer, so you're paying 7.5%. So again, there's that 15% again.
Yep.
However,
No, keep going. I want to hear the however.
I was going to say, so if we do, let's just take an example of you're a sole proprietor, you're making a profit of $200,000 a year.
Okay.
Okay. So what would be our self-employment taxes that we pay on that?
So if you were 200,000, let's just say that the cap, I don't even know what the max is, but let's say you're making 150 for sake of making this easier, right? Because then you're not even hitting the cap. So there is a cap on Social Security and Medicare that after about 160, any money you make after that, you're not getting hit with self-employment tax. So let's say at about that 160, your self-employment tax is 24,000. Let's just say for simplicity.
Okay. Yeah.
Your self-employment
So
tax
that's
on the money that you're making is about 24,000 added on top of all your other income taxes and everything else. But as an S-Corp, you don't have to take all of that profit as an income, as a salary. So what you're subject to and what you're hit with for your Social Security and Medicare taxes that you're paying as a business owner, you're paying yourself a W-2 as an S-Corp, and you don't have to take all of that as a salary. So let's say you set your salary at 100,000. Okay. That other 60,000 that you didn't take as a salary is still getting hit with income tax, but no self-employment tax. Savings in this picture is 15.3% of that 60,000 that you didn't take as a salary. So the savings is about, in our example, about $9,000 in taxes. That's a pretty significant savings. There's a lot you can do with $9,000. With $9,000, I can go on an ayahuasca trip in Costa Rica.
Exactly.
Yeah, I want to be an S-Corp. Sign me up. I'll do it.
And then also with an S-Corp, right, your odds of being audited are much lower.
Yeah, that is very true. As a percentage, there's a much higher percentage of Schedule Cs that get audited. Basically, any self-employed individual is a much higher risk of getting audited. It's the higher percentage marks. It's a fraction of a percent of S corps get audited just because of the likelihood they are a business, they're legitimate. The IRS isn't looking as closely into that because there's not as much foul play happening, because typically you have an accountant handling the books and you're having somebody handle the reporting there. Most people are not DIY S corps yet. I think TurboTax could change that in the future, but we'll see how that goes down the line. But at least for the odds of getting audited, it's a fraction of a percentage. So if you're working with an accountant, your odds of getting audited or odds of even worrying about an audit are low if the accountant is ethical. And
Right.
in most cases, you're going to find, especially licensed individuals, are going to be very ethical. They want to keep their license.
And that's a good point. So if you, let's say in this example, you save 10,000, now what you could do is go actually hire somebody to help you manage your bookkeeping, because at this point now, because you're an S corp, you have to file a completely separate return and you need a full balance sheet. So you really have to have your books tightened up. You can't DIY your books anymore. And so that's one thing. A lot of times, I don't know what your recommendation is, Scott, on the income level, net profit level of a sole proprietor, where it makes sense then to move to an S corp because of the additional admin cost of maintaining it, in terms of now you have to run payroll, so you have to pay a payroll provider. Now you
That
have
threshold
to have a proper
was
set of
always,
books.
yeah. I mean, and also, not to mention, you have to know how much you need to pay yourself too, because these numbers don't just come out of thin air. But that threshold typically to become an S corp, I think it is typically nowadays, I just round to 100. If you're making about 100, we could probably see a tax benefit there, and it offsets the fees because you're going to pay an accountant to do something, set up payroll, and then you create all of these other new liabilities and new things that have to be done. All these it's an administrative nightmare to set up payroll if you've never had it to begin with. So you want somebody to handle it that knows what they're doing, because every state's slightly different, and figuring out how much you need to be paid. You probably want somebody that knows a thing or two about what would be reasonable, what the IRS would consider reasonable, and that's reasonable compensation. If you'd like to learn more, there's an entire episode on that at Accounting High. Go check that out. Reasonable compensation means, what would you pay yourself? What are you worth as an owner of this business based on what you're doing? What would it cost to replace you?
Yeah, and I'll
There's
just
a lot more to unpack there too.
I guess the question would be, well, if I'm only paying that 15% on my wages, right, between the employer and employee side, why would I not just pay myself $0 in wages and then take everything out as a distribution? Why does the IRS make us pay reasonable comp? And what is reasonable comp?
That is a great thing to ask, because I myself, I don't think I've taken a wage this year at my S corp, but that is because I serve as more of a board member now. I am not actively working in the business. And that is a key difference between, do you pay yourself or not? If you are, and your business does not operate without you, you do have to take a salary, and you would need to pay somebody to do what you're doing if you wanted to get out of it. So what would you pay somebody? What would somebody be willing to do to work for? Well, I know that because I pay my people and they are keeping it operating. So I know what reasonable comp would be, because I just look at what I'm paying my managers, the team that's running the business. That's my reasonable comp. That's what I was getting paid before. That's what I was paying myself as a salary. So you would just need to know, what would it be? What would it cost you to replace yourself? That's how much you should take as a pay. Don't take more than that, because then you're just handing money to the government, Social Security and Medicare. You're just handing it off to them. So that's where your savings is, basically.
Yeah. So like to say, like, the too long didn't read version of this is a lower salary. The lowest salary possible is more tax advantageous. However, if you were to get audited by the IRS and they said the salary you're taking, take a $30,000 salary and you're making $1 million a year, they're probably going to say that's not reasonable, and they're going to deem some of the distributions you take as that should have been payroll, and then you're going to end up getting hit with like a bunch of payroll taxes if you were to get audited. And on your S-Corp tax return, there is a line item where you specifically call out your owner's compensation. So they can do a quick calculation on their end to make sure it's about right compared to your revenue. It's
Well,
very
we have
subjective.
a few wives' tale and a few myths in the accounting and the tax business. 2/3 rule. That's a big one. The 2/3 rule is the rule that we used mostly at our firm. And that was, if you take about 2/3 of your profit and then you just save the rest, that should be fair enough. Like that, everybody will stay pretty happy there. There's no IRS rule that says that. There's nowhere in the code that says you can take 2/3 of your profits. We just found that at least was safe.
When you say 2/3, you mean 2/3 through distributions and then 1/3.
Yeah, like if you made 150,000 and you took 2/3 of it as a salary, that's about 100, right?
Oh, you're saying 2/3 for the salary, so more for the salary.
For your salary, yeah. You take about 2/3 as the salary is the safe. That's the more conservative route. I have seen the other one where people say take 1/3 of it and just take 50 as the salary, and then you're saving a lot more in taxes. Those are the more aggressive. But you can see it range anywhere based on if we get a prior tax preparer's return, we see, because there's one line item that says what the owner was taking. So you usually can tell how conservative they are and how much they want to save, how much money they want to save their clients too, how aggressive they want to be, because it's just not like, if you're only taking 20, 30,000, you might as well not take anything at all. That's not reasonable.
And at the end of the day, the tax preparer is the one signing that tax return. So ethically, they need to feel comfortable with that number. So it really just depends on what your tax accountant is comfortable signing at the end of the day.
Feel like it would hold up reasonably in an audit. And if the IRS doesn't think it's reasonable, they'll tax you on the whole thing. And they can. They have the right to just say, here, all of this is now subject to your SE tax because you didn't take a reasonable, and we have some comps to prove that. And so we've definitely seen that happen too. We just don't want that. We'd rather save the money up front than have to deal with something like that in the back end. But a lot of accountants, tend to play it safe too. And that's why you're using an accountant, because you don't want to pay penalties and stuff later if you can avoid it.
And to your point about you're not active in your accounting firm anymore, so you don't pay yourself any wages. And there's also situations where someone might be part-time in their business, and so you wouldn't want to pay yourself a full salary. So it's important to have that conversation with your tax accountant and then decide on a number that feels comfortable for both of you.
Yeah, for sure. I paid my dues. I took salary as long as I needed to. Let's move on.
Okay, so once we've decided on a salary we feel comfortable with, then the next question is, okay, well, how much can I take in distributions?
Ooh, okay. Remember, too, if we're talking tax side of this, it doesn't matter what you take in distributions or not. You're still paying income tax on that. So it doesn't change your tax based on what distributions you take. It's just the salary that determines the tax. So
I find that I have to repeat that at least 5 times. You're not taxed on distributions. You're not taxed on distributions. A lot of times,
not taxed on distributions.
I'll say it one more time. You're not taxed on your distributions.
You are not. And you can leave them all in the business. You don't have to just take any distributions. And guess what? You're still paying tax on that. I wrote a whole rap on this. Taxable income is not cash flow. 2 different things.
You are taxed on your 2 things, right? You have your W-2 that you're going to receive from the company, and then your net profit of the company. So what you see on your profit and loss statement is reported on Form K-1. So you're already paying income taxes on that. So whether you keep it in the business or transfer it to your personal account, that's not going to change anything tax income-wise.
Thank you.
So because this is the cash flow show, right, I want to just point out something here that sometimes what can happen is a business owner will take out more in distributions on a monthly basis than what the company is generating from operations.
I've seen that.
And they're like looking at their P&L and they're profitable.
Why? Why aren't we making any money?
Where did all the cash go?
Yeah.
Well, the first episode, we talked about fixing your profitability problem. Episode 2, we talked about collecting from customers. So what can happen is we're making a profit on paper. We're not collecting from our customers on time. We're still taking distributions. And all of a sudden, we've got ourselves in a situation where we're running out of cash.
If I could, I've got a lot of stories. One of them involves factoring too.
Ooh.
So Yeah, yeah, that's a whole nother one. I don't want to get into that right now. Let's all just say that trust your accountant too when they're telling you these things because they know what's going on. Is that there's not going to be money hiding somewhere. They're not going to just find, lift up a seat in the couch cushion and find a whole bunch of money you can use. First and things first, you got to control the spending. That's the first part. We got to dress the wounds here. We're bleeding cash. Stop the spending first.
Right, which we should have already figured out with episode 1.
Yes.
We got our profit margins in line.
Yes. All right.
So
yeah, that's good. It's good. We've already made it to episode 3. I forget.
okay, so here's what I usually recommend. In our business, we need to have some amount in cash reserves. And we want to have that amount in cash reserves in our business before we start taking any distributions in addition to our salary. So we should be getting paid our salary every month because you're an employee of the business. And then the distributions is really based on the profit that your company generates. And in episode 1, we talked about how that should be, depending on your industry, we'll call it 20% is a good target net profit. So if you're making $1 million in revenue, after you pay yourself, you're making a 20% net profit. That leaves you with around $200,000 that you should be able to distribute to yourself.
And you should
However,
distribute that.
however, in year 1, right, we want to build up a cash reserve. So the first couple of years, you may not be able to take out that full net profit of 200,000 because you're going to build your cash reserve first. Does that make sense? But you're still going to pay taxes on that 200,000.
Right. So what I used to have a patented thing I would tell my clients to have a zero line, basically a dollar amount that was about a quarter of expenses, maybe a little more, but like say, how much would you need to cover this, cover payroll, cover all your fixed expenses for several months, and roughly call that your zero line. Anytime your bank account went lower than that, you're in the red. Consider that your zero line. No pun intended with zero. This is before we were using zero, I think. So let's say it was 100,000.
Yep.
Anytime your bank account went below 100,000, you're dipping into the red, basically. That's the way you need to psychologically look at it. 100, 200,000, whatever it is. And that's something that I used to tell them to change their mindset around that, because then they wouldn't ever run into cash issues. Then if they're really spending and looking at it like that, they're creeping into the red, or if they've hit the red, then they have to start making some changes then and start making some corrections because they're spending more than they should be.
Exactly. And so usually I recommend anywhere from, if you look at all your expenses on a monthly basis, anywhere from 2 months worth of expenses to 6 months. And typically, if you have a type of business where it's recurring revenue, you're getting paid up front. There's a lot less risk in that type of business. So like for you and I, we may have like 1 or 2 months of cash reserves versus a business that's highly volatile, has 60 to 90 days before they're getting paid, projects, very unstable. That's a situation where you'd be on the higher end of cash reserve. So the point is pick a number, and then exactly what you said, Scott, that's our target number. And we are not going to take anything out of the business until we're above that number.
Yeah, and you can put it in a high yield account. You could stuff it somewhere where you don't need to look at it if you really need that help psychologically, and don't see it, don't touch it kind of thing. You can do that.
That's a good point. So I do that because you remember you talked last episode how you had too much money in your bank account at one point when you switched when you switch your billing cycle, and then you overhired. So that's what I like to do. I have that target, and I want to stay like right on that number, and then anything in addition I'll take out, and I'll just move it to. Interest rates are super high right now. Put them in a high interest checking. You can always put it back into the business if you need to.
Your cup has runneth over, and you can put the overflows in some extra high yield account, right?
Exactly.
So what about saving money for taxes? The old popular profit first method would take some percentage out first and put that money saving for taxes. 10%, boom, save it right over here, or something like that. I forgot.
Yeah, I don't remember what the recommendation is in the profit first methodology, but that's a fine DIY method. However, if you are working with a tax accountant, typically what you guys do, right? Correct me if I'm wrong, is after you prepare the tax return for the prior year, you generate quarterly tax vouchers, which is basically forecasting what the net profit will be for the following year and then breaking it down into quarters.
We do it even differently. We do
Really?
that for the people that don't take salaries. But if you take enough salary, we basically over withhold. We take almost their whole salary and make it all go to withholding. So we've planned ahead so we know how much withholding they need to take for federal and state to cover them at the end of the year, plus their self-employment taxes. They're not having any self-employment taxes. So this is just their income taxes that we're projecting. And then we just over withhold. So maybe their paychecks is nothing because they're taking $60,000 a salary, but all of it's going to state and federal taxes. So
that's exactly what I do. So I pay myself a salary, but my take home is $0 from that salary. And so there's two ways that you can pay in for income taxes. You either withhold it through your W-2 wages, or you pay through quarterly tax vouchers, or both. But I like the methodology of just using 100% of your wages for withholding for federal, state, and then 401k. If you have 401k, your net is $0. So you're paying in every 2 weeks for taxes. And then you're just living off of your distributions, basically. So if you take a $10,000 a month or $20,000 a month distribution, that's your stable income. You've already covered your taxes and you're good there. And you can just take that and live off of it.
And guess what? That's effectively what Profit First is doing. Except we're just paying the money directly instead of letting it sit in a savings account and holding it aside. We're paying it directly every quarter, so then you can't touch it. And if at the end of the day you owe a little bit at the end, or if, either way, the taxes are already being paid on your behalf through payroll. So
and it's a little bit more exact because Profit First is only looking at your business, whereas these quarterly tax payments and the tax that's being withheld is your personal income taxes, because an S-Corp is a flow-through entity. So you may have real estate holdings. You may have a spouse that has W-2 income or has another business. And so these tax vouchers are really more precise than just taking a percentage and putting it into account and then, hoping that you remember to actually pay in the...
Yeah. Or not only that, but then just it's fewer surprises. It's more of a science, and what we're using is math, to do that instead of just a gut feeling of how much you might owe based on this and this and this.
The other thing I like to do with my tax vouchers, because I typically have the vouchers and I have the through payroll, but I take those right when I get them and I put them into my accounting system, into accounts payable.
Ooh.
And I set them up so that the date is so let's say it's due September 15th. I date it September 1st. It pops up in AP September 1st, and then I pay it. And so you kind of always see the tax payments coming. And then again, going back to that cash target number, in the month that you pay your taxes, your distribution might be smaller, right? Because you use some cash to pay your quarterlies, and you're not taking any distributions out unless you're reaching that target. So you've taken care of taxes. You've got your cash reserves. You've paid yourself a reasonable comp. And now whatever you have left is yours to keep.
Doesn't it feel good too when something's unspoken for? Then you can really then you can really plan what to do with your money, and you can be intentional with it instead of assuming, oh, now I don't know if I can even spend this because I'm going to owe money at the end of the year, I think. So I don't know if I could overspend, and then how am I going to pay my taxes? So it's a peace of mind. I really like that you also mentioned the 401k contributions too, because not a lot of people save for retirement anymore either. As an accountant and as somebody who's fiscally responsible, I don't like to see that. So to hear that you're saving for 401k, this is great. You're already ahead of yourself.
Yeah. I think a lot of business owners think that their business is going to be 100% their asset, and so they don't, but we really should be hedging our bets, I think.
I don't know. That's me. I don't save that much for my 401k. I'm hoping that's my business. I can sell my business, right? That's my retirement. So distributions. Are we gonna keep going down the distribution 101? Let's talk about where that shows up on the financials.
Yeah. And I put this point here because I get asked by clients all the time. They're like looking at their profit and loss and where are my distributions? So Your distributions, again, do not show up on your profit and loss statement. They show up on your balance sheet and your cash flow statement. So your distributions are just a return of capital, which is why they show up on your balance sheet. So if you want to see the impact that your distributions are having on your cash flow, what I like to do is I'll run a statement of cash flows out of your QuickBooks Online or Xero, and I run it month over month. And all that top area that's operating, just consolidate all that. You don't need to see all the in and out crap. Consolidate the operating section. So that top section is your net profit from your operation. So that's money coming in from customers, expenses going out to vendors, and payroll going out, your normal ops. Okay. So hopefully that's positive. Then the next area is going to be things like fixed asset purchases that hit the balance sheet. And then the last area is going to be where you'll see your distributions. So you can see how your net profit or net cash flow from your operations might be positive, but then you take your distributions, and then at the very bottom, you might see that your cash flow for the month was actually negative, even though your cash flow from ops was positive, because maybe you bought some fixed assets, maybe you paid back a loan, or maybe you took out distributions.
Yeah. So it's just important to understand the types of things that don't show up on that cash flow state, or they would show up on the cash flow statement, but which ones you're adding back in there. And that's typically, like you said, loan payments, distributions, and fixed asset payments that are being depreciated, or fixed assets that would be depreciated. So
Right. So that's why I recommend, and a lot of times people are only looking at their profit and loss statement, but they really should be looking at their cash flow statement as well. And then the balance sheet is more of a check. So as a business owner, I would recommend to take a scroll through your balance sheet and just make sure, gut feel that, hey, this loan balance on here, is that what your expectation is? To just double check that your bookkeeper or accountant is doing a good job.
yeah, and you don't see accounts in there that are just way out of whack, because most of the time we look at somebody's balance sheet, the first thing we do is see some really off the wall accounts. That's where all the things get squirreled away for most bookkeepers or accountants that don't look at it. They just stuff in the balance sheet. So there's certain accounts that we can see are being plugged.
And usually that's like a new bookkeeper who they're good at inputting things, but they don't understand the output. And if you're the business owner, you may not understand the output either. But you can do a quick check to be like, okay, why is my cash balance negative? Or I know I only have $20,000 in the bank, and this showing I have $1 million in the bank. Like, just do a gut check to make sure it's correct. Because really, our balance sheet if our balance sheet's correct, our profit and loss statement's correct, our cash flow statement's correct.
So the firm I'm at right now, you should have seen some of the balance sheets when I started, because the owner was just doing write up for the tax return, and just basically the cash accounts didn't mean anything to him. His reconciliations didn't exist. They didn't happen. As long as all the expenses were being accounted for, that's all that mattered. That and the income correctly. Any other balance sheet type account didn't matter, because you're not required to have a balance sheet on that tax return. On most 1120S's, if you make a certain amount or you're below a certain amount, you don't even have to produce a balance sheet on that return. So some of these accounts had like negative $1 million in them because there was no money being deposited in. It was crazy.
That's terrifying.
It was a lot for us to fix that. We fixed it all, but oh man, a lot of accountants, they just do stuff straight up, like just for the tax return.
Yeah, we have a client that the cash balance, because we always tie out Schedule L, which is the balance sheet on the tax return to the books. Like, that's where we always start. And we had a client that the cash balance was just completely wrong compared to like what the bank statement said. And so he got so mad. I probably called him at the wrong time. It was probably like tax season. And he was just, what are you, an auditor? I'm like, no, I'm just trying to reconcile the discrepancy, because we're trying to like correct the books, and it's off by $100,000. And like, so he wouldn't answer me. So I just had Jen on my team put like a line item there that was like discrepancy that CPA could not explain, or something like that.
Oh man, CPAs get very defensive if that kind of stuff happens.
Yeah, and we always try to work. I'm very nice. I really want to. We have tons of CPAs and EAs that we work with that are awesome. We have a great working relationship. I would say it's like 5% where usually like the old school guys that
Yep.
don't want to work with you. And they just honestly, a lot of times talk down to you because they're like, we were talking, he was like, you're just a bookkeeper, da 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 da. And I'm like, okay, I'm a CPA and I'm trying to help you so your job's easier. But there's just like that perception there.
Yep. Well, just be wary of these kind of things. You know, that's why we bring it up in the cash flow show to arm you and equip you with knowledge and advice so you don't run into cash flow issues in the future, especially if you have in the past. We want to fix those problems. In summary, Nix.
Yeah. So in summary, point number 1, S-Corps require that you pay yourself a reasonable salary. So work with your tax accountant to choose a number that works for both of you. The long and short of it is less is better from a payroll tax perspective, but be careful about choosing a number that's too low because you could get audited and then you may end up having to pay back taxes. Point number 2, choose a cash reserve number that you feel comfortable with. So between, for example, 2 to 6 months of expenses, and then use that as your target before taking out distributions. Work with your tax accountant to set up your payroll withholdings so you're paying into Fed and state and your retirement regularly through those payroll withholdings. And you'll also be avoiding the shock and disappointment of a large tax bill at the end of the year.
Yes, exactly. Nobody wants a big tax bill at the end of the year.
And then step 4, put your tax vouchers, if you have those in addition to your wage withholding, if you have additional taxes that you need to pay, put those into your accounts payable so you can plan for them and pay them in a timely manner. And then each month...
or do a tax plan mid-year too. That's another thing that you could do.
Right, especially if you're growing quickly or you've had a huge reduction, because the tax plan that your tax accountant did, 6 months ago, it could be way off if something significant happens in your business. And then each month or each quarter after you've paid your tax vouchers, you can take out whatever cash is in your account above your cash reserve number. And then finally, if you consistently don't have enough cash to take leftover after all of this, and you're like, what the heck? This sucks. Like every month, I'm never hitting my target. Well, you need to go back to episode 1 or episode 2 and see, and also look at your statement of cash flows to see if there's any insights you can pull out there.
And don't worry, we will revisit episodes 1 and 2 in the future too, for those that get into trouble again, because it's cyclical sometimes. Businesses are seasonal and cyclical. So some problems that we've run into in the past, we run into again. The sun goes up, the sun comes down. It all repeats. Once again, you've been a world of knowledge for us, especially us business owners that don't have that much direction. We need some guidance. We need some help. We need to get our heads above water. And we've got you here, Nix, to help save us all. Thank you.
Thank you, Scotty. I appreciate learning about your insights too on the tax side. So if you need help with any of these things, if you need help with taxes, definitely reach out to Scotty. If you have your S-Corp that is up and running and you just need help with payroll or setting up some of your back office things like setting up your accounting system or bill pay or some strategies around cash flow management, then you can reach out to us and by going to momentumaccounting.com.
Dope. Yeah. Thank you for joining us on the Cash Flow Show. Our next episode, you're going to learn about paying others. Today, you paid yourself. Tomorrow, you will pay others. Peace out, Nix.
That's right. See ya, Scotty.
Yeah. So you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you're running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. You're CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cash Flow Show. This is the Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cash Flow Show. The Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Our advice will take you far. Cash Flow Show. Tune in with Nikole and OKR.